Awesome. So I think today Aditya is going to tell me about something very interesting, which is how there are companies around the world who are essentially using Bitcoin to drive up their market valuation. So their core business is something completely different. However, they found this strategy where they keep investing in Bitcoin and it is directly related to how their stock prices are going up. And a lot of people who can't take bet on holding crypto within their own wallets, maybe for regulatory concerns or taxation concerns or whatever may be the reason, are now finding this indirect way to invest in Bitcoin and cryptocurrencies by buying shares of these specific companies. We have Microstrategy in the US and we also have Jetking as an example in India. And I wanted to learn a lot more about what is happening, what is going on. Does it even make sense for financial investors to evaluate this strategy from the long term perspective? Aditya, the floor is yours.
Yeah, okay, awesome. So I think this episode needs the biggest disclaimer that this is not financial advice or a suggestion to trade. The companies we mentioned are publicly traded. We don't hold anything here. This is not a pitch for any of them. This is just a very interesting concept that sort of was pioneered by Michael Saylor of Microstrategy 5 years ago and has now exploded for a variety of reasons, and so is interesting to study and understand what the implications are. The interesting way to frame this on how this all started, right, is it's effectively a story about beliefs and how do you act on a belief, right? Like if you have a very strong belief, you typically have three options on how you want to act on it, right? You can vote with your voice, your feet, or your wallet, which means that you can either complain about something or talk about something, right? You can just say that, hey, this is not right or this is right, or educate people. You can sort of talk about stuff. The second is you can build stuff, which is the hardest thing to do. Like if you have a belief of something, you can go act on it by building a product. Or the third way is you can trade something, right? You can decide to short something, long something, bet for something, bet against something, and you're expressing your belief when you do this, right? This is my sort of storyized version of this. Okay, I've not met Michael Saylor or spoken to him, but based on his actions, this is what my read is, that he has this belief, like many Bitcoiners, that the fiat money system is worthless, right? That the sort of fiat money system has gone through hyperinflation. It's not pegged to anything. It's being used for political reasons. And so this fiat money system is worthless. And all the fiat denominated assets like stocks, bonds, and credit are also facing the same asset bubble or hyperinflation, because when excess money gets printed, all the asset prices go up because smart financial actors know that, this sort of money debasement is happening in a way, right? My guess is that this is a belief that he holds, and he's sort of spoken about the theory of Bitcoin many times in this context. Because of that, he has decided to action a simple playbook back in 2020, right? He said that I am going to print the thing that is worthless. So I'm going to print more stock of my company, or I'm going to take more debt in fiat, which I think is worthless. And I'm only going to use that to buy Bitcoin, which I think is the hard reserve asset that is going to be the asset of the future, that is a digital asset, right? This is the simple setup he made. At every opportunity that he can, through his publicly listed company, he will either print more stock or he'll borrow more dollars and he'll go and buy Bitcoin. Right? This is in just if I had to bring it down to one thing, this is a belief he has, and this is how he's acting on it. Right? The homepage even today reads, build an AI ready sort of trusted data foundation for your enterprise. Right? So B2B SaaS company that has sort of implemented AI. In the year 2020, this company was worth $4 to $5 billion, like the market cap of the company. The market cap of the company today, do you want to guess how much it is?
I'm assuming it would have gone 5x. So
It's
is it like closer
25x.
to what? But has Bitcoin risen by that much in value over the past 5 years?
So Bitcoin has 10x and his company has 25x, which is also an interesting point and is a new metric in public company reporting that we'll sort of get to once we go through the context. It's called MNAV, which is basically a multiple
Multiple of the
on
net
the net
asset
asset
value.
value. Yes, exactly. There you go. This is
So it's
right up
almost
your wheelhouse.
so it's almost like the PE ratio is now changed to like an MNAV for these companies.
Yes, yes.
But then don't you also think that logically from a financial perspective, it should be like a 1 NAV, or like 2.5 is also saying it's because if it continues to be 2.5, it doesn't make sense. It has to tend to at one point in the future to 1, right? Only then does it make financial sense.
This is a brilliant question, and we have a section on this. I think 2 or 3 sections down. So just sort of park it for now, but we will get back to this.
Sure.
We just go through what MicroStrategy is and what they did, because it's also a story of 5 years of conviction of this person who was sort of called crazy when he kind of started out, right? So back in 2020, they borrowed $200 million from the bank and just went and bought Bitcoin with it. Right? That was the very first trade that they made, and so
So even the banker has to have a policy which is pro Bitcoin or pro crypto to even
that's right.
approve such in the first place.
For sure. So, I mean, this guy made no qualms about why he wanted the debt, right? He was very public. In fact, if you go to their company website, because they're a publicly traded company, under their, press releases or media section, you'll find every single, debt issuance that they did or every transaction that they did is listed, the amount they bought, why they bought it, and the doubling down of their conviction is documented. So he made no qualms about the fact that he was setting up this ideological framework, what he calls the Bitcoin standard. And so he found a banker who shared his belief, and was willing to sort of underwrite. I think in 2021 he got a 7 year or 8 year convertible note, which means that it's debt, it can be converted to equity at some share price which is way lower than what he's at today, but he got like a 7 8 year convertible note, and he's sort of racked on since then, right? So he started with $200 million of debt with one Bitcoin purchase in 2020. He sort of currently, if you see their holdings, he holds 640,000 Bitcoin, which is worth, the BTC NAV is I think around $75 billion worth of Bitcoin on his balance sheet, and for which he has raised like $7.3 billion of debt or equity or whatever, like funding to buy that Bitcoin. Right? So his leverage ratio is like I think 20% based on the market cap, because the market cap of the company is $110 billion. So the market cap is like 110 billion. He that has like $75 billion of Bitcoin. It has I think $5 million of operating income from the IT business or the AI business, or whatever the other thing is. And it has $7 billion of debt that it is like senior debt or like long term debt and a bunch of that.
To my mind, it seems a lot like this is almost like a SPAC now, a special purpose acquisition company. It's almost like convincing an investor saying, this business is growing at single digit per annum and we don't see a lot of future, and let this continue the way it is, and let's kind of diversify, bring this, and this ends up becoming their main business. And you essentially just need an equity investor who's willing to believe in you and saying, rather than us setting up an entity which is absolutely bare shell and has no operations, let it have a business and let's
Yes.
take this bet. If it does take off, I mean, our other business ends up becoming just single digit percentage contributor to the overall gains in the company.
That's right. That's basically what he did. He said that the best use of I mean, this is also an interesting question, is that if you are a quote unquote boring business with, cash flows, you have a mandate to, maximize shareholder value, as the meme goes. And what do you do in that case, right? Like, and so you either go and invest in venture. Like there's this famous thing of Infosys should have invested in OpenAI instead of doing the share buybacks, right? Now, both of these are in a way, in some ways, I'm assuming, and you should tell me, this comes from like your fiduciary responsibility to shareholders, right? You either sort of put the money to beat the market or give it back to shareholders so they can put it somewhere else, right? That's broadly.
No, that's true, and I think it comes from the fundamental principle of finance, something that was articulated very well by Professor Ashwath Damodaran of NYU, where he said that essentially in finance for any business there are three decisions they need to make. The first is the investment decision, which is to say that, okay, our business is growing. Which kind of capital assets or where in the business do we invest money so that we keep generating returns for our shareholders? The second question is actually the financing question, which is to make these investments, do we raise debt and equity, and what combination of the two, such that my cost of financing is lower than the return on investment I get from investing in the assets. And at some point in the market cycle of your business or the maturity of your business, you reach a point where you realize that now maybe the shareholders can generate a lot more value in other assets. Um, and it comes to a dividend decision that if it so happens your business is no longer sexy and there are other opportunities, you kind of return it unless you find a new opportunity to invest business in. And I think this model, on specifically on when you said about Infosys, of course, neither of us have insight on whether they ever debated this and to what extent. But I would assume that's also the problem of very large enterprises, which are under a lot of public scrutiny and have a lot of retail investors, is that it kind of takes away your agility to take these bets. Um,
Yeah,
which is why it's the younger people who don't have that much to lose, or don't
yeah,
have those many stakeholders who've actually put their life savings in you,
yeah,
um, that they can take these riskier bets. And then, of course, when it plays out in hindsight, it'll seem like, oh, this was amazing, and God forbid, had it not worked out, I mean,
yeah.
it could have lost a lot
It
of
can.
money for investors. Yeah.
Yeah, I mean, this can also still blow up. We'll sort of also get to what his risks are, right? This is by no means like 5 years old. So that's come with risk. And the sort of second half is also going to talk about why there's like immense amount of risk being sort of bundled into these companies now. But the sort of principle, that you also mentioned is that if you have excess capital being generated as a company and you express the belief that this existing money system is Ponzi, which is like, okay, it's a radical belief, very few people may share it, and you decide to express it this way, you find a banker who agrees, you find a board of directors that agrees, you're sort of good to go, right? And if you look at his, if you look at his conviction here, just look at the trade sheet. This is all publicly available in their announcement on their website. But he started buying Bitcoin at $11,000, and he sort of just consistently every dip, every rise, like it's sort of constrained by two things. I think one is the access to capital he has, and B, this MNAV principle that they've also enshrined into their company documentation now, that has brought them to this point, right? But
Here
yeah,
I do have a view. It's almost very similar to how, a lot of times when companies have access to a lot of capital, what they realize is that instead of organic growth, let's focus on inorganic growth, where if we can acquire someone at a lower multiple and we ourselves
yeah,
are trading at double the multiple, um, it just makes sense to start using that capital to just acquire
yeah,
companies. And that's what happened even in the case of Byju's, where they had raised close to $5 billion in funding and utilized almost close to three and a half billion dollars just in acquisitions, because they were trading at, say, like a 5x revenue multiple, and they could acquire other businesses at 2x revenue multiple. So just you end up becoming almost like a private equity company, because
that's right.
you're just saying, I am playing on this arbitrage of multiple that I am getting compared to the actual value of the asset, which is
Correct.
why these bubbles also don't last. So my traditional mindset also tells me that this 2.5 nav practically in the real world doesn't make much sense, and it someday it has to rationalize, otherwise this bubble is going to burst.
Yeah. So yes. So we sort of get to that bit now. Right? So their nav, their MNAV right now is 1.54. They've enshrined into their company documentation that whenever their MNAV goes above 2.5, they will issue more stock and use that issuance to go buy more Bitcoin, because they recognize that their share price is overvalued, and they want to go sort of like dilute shares a bit, and then go and sort of acquire Bitcoin. And so again, he's very aware of the fact that he's walking a tightrope when it comes to like the debt obligations and being able to manage these expectations. It really requires a lot of traditional financial discipline to not blow up, right? I think there were also a lot of trackers, because you know exactly when his debt is due, right? And you also know at what price of Bitcoin his Bitcoin holdings will start falling way below NAV, and he'll be forced to liquidate. Like you can sort of track this pretty openly, because you know what price he bought the Bitcoin at. The debt that he raised is publicly declared, and so
Hmm.
I'm pretty sure a lot of Bitcoin shorts have tried to see if they can force a liquidation on his position. In fact, there's a lot of articles out there that the biggest systemic risk to Bitcoin might end up becoming MicroStrategy, because if the price falls, as you know, Bitcoin is ultra volatile, and so the price falls to a point where he starts getting liquidated, and there's a cascading set of liquidations. He then has to start selling. Basically, a liquidation is he has to start selling his Bitcoin to pay back, and make whole his lenders fast, forcing the price further down, creating a spiral, right? And so There's
Yeah.
this is like known, and this is, I mean, it is a real risk. Um, but
And I think it's
he,
also
yeah,
problematic. I think you said, or I kind of read somewhere that it's among the top 5 or 10 Bitcoin holders in the world. And if that is the case, it essentially means that maybe they need to maintain an MNAV of no more than 1.2, 1.3, because when you're practically among the top holders of Bitcoin in the world, that spiral is the impact of that spiral is going to be much worse than what it would have been otherwise.
for sure. For sure. No, that's true. In fact, if you look at the bitcointreasuries.net website, you can see this is only within, the digital asset treasury companies. Obviously, it won't include non-public holders, but you can just look at the scale, right? Like you look at like MicroStrategy is number one with 640,000 Bitcoin, and the number two company listed here. I don't know how accurate this is or who maintains it, but it seems reasonable. The number two listed company is 52,000 Bitcoin, right? Which is like 10% of MicroStrategy's holding. So I would assume if you add up number two to number 100, you will end up with less than what MicroStrategy has. And of course, that speaks to size and conviction. But yes, so there is some systemic risk built in here that he needs to safeguard against for his own sake and for Bitcoin's sake to some extent. But he's ended up in a position where he has like the 10th largest corporate treasury in the world, more than Nvidia. If you look at cash and cash equivalents and like a corporate treasury settings, like right up there, just after some of the Mag 7 in terms of just the corporate treasury holding that. And so, okay, all of this is to say, okay, so he saw an arbitrage where he said that fiat money is broken. I can just print debt. Like, you should also ask, well, why were these bankers giving him debt to go buy Bitcoin? Right? It's like, what are you thinking? Clearly, there's some truth to his insight so far, 5 years in. What has happened now? The other interesting thing, which also gets to your MNAV question and operating business question. Now we've entered an era where, at least in the US, sort of crypto assets are just a new asset class, right? Like BTC, ETH, a lot of these other tokens are, they're a new digital asset class that is being sold to family offices, and pension funds and investors are taking it up on their as part of their treasury, as part of their portfolio, and so they're assets in and of themselves. Bitcoin, as we've spoken about before, does one thing and one thing alone, right? The Bitcoin blockchain is not programmable. It is the most resilient, decentralized. Proof of money was the thesis it came up with, and it has willed its way in some ways because of the believers and holders it had. It has willed its way into a $1-2 trillion asset that it is today, right? But it doesn't do anything. And so when you do a Bitcoin treasury company, it is primarily about you're either arbitraging the tax treatment or access to capital mostly. Okay, there is some DeFi, some payments, but it's not the main thing. You'll never hear Bitcoiners talk about it that much. What is happening with, there are now digital asset treasury companies on ETH, on Sol, and on other assets as well, right? Now these assets are sort of productive in the sense that at least within their own ecosystems, they have yield, they have DeFi, they have lending, they have borrowing, they have staking, they have burning, they have other tokens that are launched on the network that trade there as well, right? And so that introduces a new dynamic, and is best articulated in the recent sort of Solana DAT that happened, was called Forward Industries by Kyle Samani. He, in a recent podcast, articulated this well, where he said that they've acquired $1.5 billion of Sol as part of a private investment in a public company. It's called a PIPE, and they're doing an equity issuance for another $4 billion of Sol. It's all public news, right? So they are going to market by, they're going to raise $5 billion in like cash and go and market buy Sol with that, right? Now their argument is that once they have this treasury, this is like a very sizable treasury. They'll be the largest treasury company for that holds the Sol token. So their argument is that they can then take actions with that Sol which will be value accretive to shareholders, such that for every Sol held per share, they can generate more Sol per share, right? Whether this is from the 7% staking yield that comes, whether this is by negotiating with DeFi protocols and saying that, hey, we have this massive capital base of Sol, we'll invest so much into your protocol, but we want, a better interest rate, or we want some tokens from you, like we want equity ownership in your protocol in return of bringing the scale to you. right? And these are win-win deals because as a DeFi protocol, you get access to at scale, traditional capital. The third interesting thing is that they also want to be the guinea pigs for all of this tokenization stuff that wants to happen, right? If you need to tokenize equity, if you need to tokenize, if you want to tokenize credit, you want to run a company on chain, on a blockchain, as has been theorized for so long, you need a crypto native team to go and do all of this, right? You can't expect a traditional public company to take on that risk themselves. And so they are trying to actually run their own company on Solana, like issue their equity on Solana, tokenized on Solana, and be compliant with all of the public company requirements in the US. And so this is an interesting fork in the digital asset, treasury company space, where a publicly listed company acquires a lot of the underlying asset. There's also a digital asset treasury company for ETH. It's run by Tom Lee, I think his name is. He's very famous. He's going on all of these, all the interviews. He's doing the full interview circuit and talking about how ETH is the asset. And so this is, again, getting competitive between assets as well. I think his treasury size is 10 billion plus. He holds as much as Ethereum Foundation. So it's happening everywhere, right? Every DeFi ecosystem, or at least the big ones, they've realized that, okay, you can use a public company as a vehicle to acquire access, to acquire legitimacy, to acquire size from investors who would otherwise not be able to buy the underlying asset directly, and then deploy it into quote unquote productive finance, which is, yes, it is within the ecosystem, but it is still generating yield and is being used for traders and is being used for like validators and staking and all of these other things, right? And so it then also creates this thing where if somebody wants to tokenize their stocks on Solana, these guys can be buyers, right? You have a public company now that is a potential buyer and can catalyze some of these product improvements. And so this is another interesting fork of digital asset treasury companies, that which is why this whole thing is interesting now, because this just happened in the last few months.
Yeah, so my question here is that do you think Bitcoin, quite like gold, is absolutely a non-productive asset? Um, and that's where Solana and ETH are different, or Bitcoin continues to be a productive asset in some way, or maybe just the white paper for ETH and Sol were written in such a manner for them to be productive, which as the very nature of Bitcoin, it's not. And if that as an understanding is correct, don't you think how suddenly Bitcoin came into this world, and over the past decade or so has gotten to this kind of value? At some point in the future, when we're really believing in digital assets, some other digital asset, it could be ETH, it could be Sol, it could be an XYZ, could actually come in and see a lot more mass adoption, because the timing of it entering the market is actually better, and which is when all these public companies really betting on these digital assets may really crash in value. And is that a real possibility? What do you think?
Uh, I think it's very improbable. Like technically, it could happen. It just seems incredibly unlikely because everyone has a lot of tokens have tried, right? Like a lot. In fact, I mean, the argument that the Ethereum ecosystem or the ETH token holders make is that ETH is a better Bitcoin because ETH is sort of both. It has all of the resiliency properties that Bitcoin has, but it is also programmable and also has this smart contract stuff. But somehow, in terms of store of value, Bitcoin has retained massive dominance, where I think it's still 4 times the market cap or even more than that of Ethereum when it just comes to what people buy the asset for, right? I think it's maybe just the fact that it was the first one is special, maybe because the community and the validators refuse to let the network do anything else and say that the risk introduced by any smart contract is so high that we don't want to risk the store of valueness. We don't want, like, it's sort of the only major blockchain that still uses proof of work is Bitcoin. Every other network uses proof of stake, right? And Ethereum transition from proof of work to proof of stake. Now, you could argue in some ways this risks decentralization, because in the Bitcoin blockchain, no matter how much Bitcoin you own, you can't influence the validators directly, right? Because it's a proof of work network. So every validator competes. You could influence the validators outside the network by going to them with the Bitcoin and striking deals and all of that because they're humans ultimately. But in proof of stake networks, the more of the asset you own, the more likely your validator is to get prioritized for creating blocks, etc. So these are trade-offs, right? And but you're a lot faster, you get less spam, all of those issues are improved. And so the Bitcoin community has been very has not budged. Like there's this concept of the intolerant minority that Nassim Taleb has spoken about. Is sort of like intolerant. They've been very intolerant on this idea that no, this thing just does one thing. And so the odds of any other asset, there will be a lot more assets. Every asset will try to have a digital asset treasury play, right? Because in the bull market, when things are frothy, is just arbitraging access to capital. And there's a lot of we sort of talk about the risks of crypto, but also TradFi has productized a lot of this financial engineering with preference stock and these multipliers and long-term debt and convertible notes. And so you can apply all of that engineering as well to sort of fundraising to maximize your outcome as the team that is running the digital asset treasury company, right? And so a lot of those risks do come in, but the odds of another asset doing this, I think, are at least of like another asset doing what Bitcoin has done. It's improbable, but anything can happen. So don't take my word for it. Going back to like the ETH Soul and these sort of productive ecosystems, is the interesting thing here is if you go back to the MNAV, right? It's like, yes, in an ideal world, the efficient market hypothesis would be that you should have an MNAV of 1, which means that if you have no other business, your sole only business is operating this digital asset treasury company, your company is valued at the NAV of the assets that you hold, right? But few things happen, right? One is we were just, before we started recording, we were talking about trust. If you lose trust in management, where you feel like, okay, do they have the assets? Have they been selling the assets and replacing them with other assets that they've not declared? Because this is also what FTX did, right? Where they swapped out customer assets for other assets that were marked up, etc. So if you lose trust in management, you may go to an MNAV of less than 1, right? Because they don't trust you that you have the assets that you claim you do. In those cases, you may end up getting acquired. If you're very, very high trust management and you are able to deploy that capital within these ecosystems, let's say the ETH ecosystem or the Sol ecosystem, to generate more ETH or Sol, you may then end up getting a NAV that is marked up as well. But the truly interesting thing from a product point of view or as an observer is that you have now a new class of vehicles that are significantly capitalized, which are now going to try and do all of these crypto operations like banking, lending, borrowing, staking, and stuff like that, which you could not get, which you sort of could not get otherwise. Like you said, they're somewhat like private equity. Are they investors? Are they, they've raised this new type of capital where the asset does a bunch of things, the network does a bunch. There's no parallel to this really, right? Where you can buy a digital asset like ETH or Sol, and then there are protocols where you can deploy it to earn more of it. There are tokens issued on top of it that you can work with and accrue as well. And then there are the more tokenization that happens on the network because of you accrues back to your asset. There's a lot of new operating mechanics that these kind of companies unlock. They also have the same risks though, right? And the risks are magnified a little bit because with Bitcoin you have a $2 trillion asset, so it's very hard to move the price. But let's say Sol is like 150 or $200 billion market cap asset. ETH is a 500-600 billion dollar market cap asset, and so you now have these adversarial settings because at the extreme, right? These people are like they're working hard for their investors, quote unquote. They're if you look at CNBC US or any crypto US show, you will see more and more people talking about their DATs and why the asset underlying their DAT is the best asset ever, right? And so the risk then becomes that you have hostile tactics where if you have a just higher scale asset or higher more capitalized DAT, you just try to put price pressure on the other asset, drive it down, acquire it. You could have some of this playing out. You could have liquidations. Like these assets are more volatile than you're basically moving out the risk curve, right? So you're getting more and more volatile assets, which means that you could have those risks as well. And so if there's one not investment advice you take away as a listener is that don't go buy any digital asset treasury stocks just because you saw someone on TV talking about them. Okay. Now is the time when there's like a Cambrian explosion and tens and 50 and hundreds of these are coming up. And so you should be very careful, because whenever there is an explosion of something, there is a lot of froth, there's a lot of either bad intentions, which is horrible, or good intentions, poor execution, resulting in a similar outcome. So don't go buy the stock. Here's the counter trade that you probably should make, right? Is if there's a digital asset treasury company in your market, you can go get a job there as an easy way to go work in crypto, right? If there's a digital asset treasury company that is doing something that you enjoy, like let's say they are trying to get more crypto payments products live. Let's say they are trying to do things in the deepen space or the tokenization space that you enjoy. This is now a new vehicle that you can go work at without having to worry about. They abstract out all the complexity for you, right? Because they're holding the asset, they're managing the operations. You just get a job at a publicly listed company where you can go work in whatever sector you find interesting. So I think that is the more interesting trade. If you're someone listening to this and thinking about how do you get involved, go work with a digital asset company. In the process of doing that, you'll have to study about them, study about the management, and you'll find a team that has the resources and the vehicle for you to then go execute and work in the space.
No, I think that's very well advised.
Okay, now we talk about the India situation, right? And this is interesting, because you have the first digital asset treasury company, Jetking, to give you a sense of, this is new. Hats off to them. They're taking risk in their name and on their company balance sheet by doing this. To give you a sense of perspective, as of now, they hold 23 Bitcoin. Right. This is public on their website. You can go and see it. They hold around 23 Bitcoin on their balance sheet. They're hoping to build up, and so it gives you a sense of how new this is in India. One of the reasons why this could be an interesting format in India is that is this may be more amenable to the regulator, because again, this is all like hypothesis, okay? I have no inside information here. But because you have a public company which is has like a stringent set of compliances, right? You have to do like quarterly reporting, you have to send in reports to SEBI. There's a capital markets regulator established to regulate these companies, and these companies could then decide to take on different assets, different strategies. You have a low risk mutual fund, high risk mutual fund, middle mutual fund, like hybrid mutual fund. You could have digital asset companies across the spectrum of risk. They are regulated by SEBI, and so because they're like publicly traded companies, and so SEBI, like the capital markets regulator, would then understand whether these companies are complying with whatever standards it has or not, whether the declarations. Look, there's risk in buying any investment, right? Like mutual fund investments are subject to market vol. So there is risk, but is the risk being communicated transparently or not? Does the company have what the company says it has? These are things a retail investor cannot know, right? And so you have, from the India point of view, the evolving hypothesis or interesting thought experiment is these could be interesting vehicles because they are regulated, and so if they fall under a regulatory ambit, they can take on the asset exposure, and then they can figure out how to do the operations they want, whether that is marketing to investors as per the guidelines already set up for fundraising, whether that is requesting for sandbox access, or requesting for regulation that is more favorable for these DeFi activities. This may end up becoming an interesting structure through which the industry could grow. But I mean, right now there's one company that we know of, and this is where it's at.
But do you know of Jetking only because the Ken did like a report on it, or is it something that you actively track to see that okay, there are more companies which would be engaging in something similar, or there is no example which is big enough which is come into the eyes of public media yet? Or what I would say is, are you the kind of investor who can track this somewhere? Like, can you, or maybe you could tell Perplexity, because they say, Perplexity today has been built in such a way that it can actually look at real time market data to fetch you insights and make charts and stuff and comparative analysis and whatnot. And maybe people might just start giving it prompts to say, okay, I want to really evaluate how many publicly listed companies in India today actually
So
reasonable holding of these
you
digital.
know there's a saying, like, how do you know someone is from ISB?
Yeah. What?
You don't need to guess. They'll sort of tell you within a minute of meeting you,
Oh.
right? Right. And we can make this joke,
Yeah.
but is sort of the same thing with DATs, right? Sort of the nature of the business is that you have to go raise awareness among whatever category of investors you're going after. And
Yeah.
so I would say, you will. There's no every dad talks about themselves. Now they may talk about themselves on CNBC or some of the channels that do the stock profiles and all of that. They may do Bitcoin education, like education of the underlying asset. They may go to institutional investors. They may, like, everyone will pick their own avenue. And so again, I'm not an investor. I don't. I have not. I have bought zero Jetking shares. I in fact met.
Nor am I.
They Yeah, and I in fact met there's like a small world in the industry right now, and so you end up meeting each other at events and conferences and stuff like that. And so you probably the team is accessible. Like you can drop into their office, or they have educational events that you can drop into. But yeah, I think this is like if you've been trying to find the right operating entity, because there's no, when you become a crypto company, it's like how do you hold your funds? How do you do all of these things? Like you have this may end up being an interesting way to meet the regulator where they are and do it in sort of a compliant way. But again, it comes with crazy amount of risk for everybody involved, whether you're the public company doing this, because I don't think, like, there's no guideline today, right? If you look at Nitin Kamath, he says the biggest risk to any of these security financial market stuff is regulatory risk. And so as of today, I think there's no guideline on whether publicly traded companies can or can't hold Bitcoin, I would assume, and there's no reason why they shouldn't be able to. I mean, you've got exchanges in India, they provide custody services, but there is risk that you may not be allowed to. There is risk as an investor, you're sort of trusting management, etc. And so uh, this is why I keep saying the best thing you can do is uh, like either go and start one if that's your thing. If you have access to capital and you're interested, try and start something that is value accretive, or go find a job at one. Right, it may not even be an Indian one. There's now one in the UAE. There are many in Hong Kong, in the US. Just go find a job at one and just start working in the space and get a taste of what are these companies doing. Because and so then you can pick the ones that are good from the ones that might have more non-systemic risk, or like idiosyncratic risk there.
Do we have any more insight on Jetking, which is in no way um to kind of advise people for or against the company, but just information which is fun to look at?
Not really, to be honest. I think they've just started doing this, right? They just started doing this around a few months ago. They're an IT services company, so their website is like, join our bachelor's of computer administration program. And now they've got this Bitcoin treasury business that they're spinning up. Hats off to them again, for taking a stand, and it's a great risk that they're taking in their own name for a belief that they have again, which is good. I think the one interesting thing, the other thing to think about for DATs is how do you use it to try and create an operating environment for these new technologies in a way that startups can't do, right? Because DATs could become effective tools to interface with regulators in a way, to sort of meet them where they are. Because like we said, if you're a publicly traded company, you already have regulators you work with and you answer to, and you can use that framework to see if there's appetite to extend and add some more products. Because it's still not easy to do, like, the things we are talking about, like doing DeFi or doing staking or doing some of these things. These still fall under VDA activities. And so you have your I would assume, I don't know, I'm not a tax expert, but I would assume that your TDS and your capital gains tax and these things still apply, which might still make it hard for you to do a lot of the things that a DAT in the UAE can do, right? And so then maybe what you do is you raise the capital here, and if you can, you makes service agreements or operating agreements with companies overseas, within the investment frameworks that are allowed to sort of get these things done. And so it's an interesting new frontier. uh, as always comes with a lot of risk, but now that it's happening for productive or programmable assets, rather, it just allows you to do more things rather than just be a tax or like a capital access arbitrage, which is the most interesting thing in, at least for me, because I'm not a investor or finance person.
Wonderful. Also unrelated, and we can't even make this judgment based on just two companies that we've discussed, which is MicroStrategy and Jetking. But because both are into IT services in some way, um, is it is there a bias? Is there a reason why a lot of these IT folks are so pro Bitcoin and blockchain, and the finance people are the ones who adopt to these things much later? And you think it's because how the consulting companies, when they hire, they're almost like, we want to get younger people because they're not conditioned by the world and they're easy to kind of explain newer concepts to? Do you think it's something similar which is reflective here?
I would assume it's because this is a digital asset. I mean, again, like you said, it's impossible to know from n equal to 2, but I would assume it's because it's a digital asset. You're just more likely to understand it if you work in tech on the margin.
Okay, so
Yeah, potentially.
another way to evaluate is that out of all your network of people that you do know, um, in this ecosystem, who are interested um, in just digital assets as investors, as speculators, or whatever may be the case, do you think most of them just by chance happen to be techies? Because I don't tend to have these conversations with my friends who've studied commerce, and it almost never comes up other than just discussing, see what is happening in this market. Barring our shock and surprise at how at times it doesn't make sense to our traditional brains. Um, Commerce guys just don't discuss this, even though we would have been trained in finance and that's what we've studied, right? So I don't know what you techies are like consuming in the form of content. Where is it, do you think a lot of people feel that because they're techies, this is an avenue for them to kind of build a career in, and that kind of sucks them into the rabbit hole? And commerce guys would not even think of it as an active career, because everyone who's studied finance is thinking, okay, I want to get into either venture capital or private equity. Should I get into private banking or wealth management, or should I do a CFA, and should I get into taxation? And the techies today are like, okay, do I want to study AI, or do I want to study blockchain, or do I want to get into biotechnology? Because it's all new age, right? And maybe that is a reason why you guys get a lot more exposed to this.
That's actually a very interesting question. I think if I had to guess, I would say that like initially these started off as technical platforms. So if you were not a developer or technologically inclined, you couldn't even use them. And even now, if you remember when we set up a Phantom wallet for you, it's like it's a little hard. It's not very intuitive. Okay, now they have Google login and it's like any other software product, but you until like a year ago you had to write down a 24 word seed phrase and like do all these complicated things to even create an account, right? So I think one thing is that these things started off as technical platforms. They didn't really have meaningful size or scale as assets, right? And they were more technical products, and they therefore appeal to developers and you know people who were building stuff in tech. And then as more speculative capital from different sources entered, and they started a first achieving a market cap, which is the shock value, and then sustaining and rebounding back to that over and over again. I think now it's like in the at least in the US or investor markets, even in APAC, in on the Far Eastern side, now this is mainstream finance. Right now, this is no longer just in a tech. Now you got bankers and pension funds and all these folks understanding it and starting to figure out where it fits within their diversified portfolio. To that degree, I would say that if Indian mutual fund houses or if Indian financial institutions decided that, look, we've been saying this is a scam and this is not safe right from the time it was $100, it's now $110,000. Maybe we're missing something. We need to learn about this and open it up through regulated products to our investors, you would probably see that change. But I think this is also a case of, that like Spider-Man meme, everyone's looking at each other. It's like, why should I be the first one to go and say it when nobody else is? And so unfortunately, if you're average retail, you end up getting priced out fully because you don't even through an ETF or mutual fund analysis. Maybe it's that. Maybe it's just, yeah.
And thank you again, Aditya. I think this has been very insightful. As you had guessed, I found it really insightful and I had a lot of fun just learning about this. And I think I should definitely dig deeper and maybe even do an Instagram reel about it, maybe a LinkedIn post. And I know a lot of people who are aware of what's happening in crypto or even otherwise are aware of both MicroStrategy and Jetking, as I was also aware. But it's fun to get like, more nuanced view on how it started and how they got debt and how much it's grown and the concept of MNAV, which is very new to me, but it sounds really fascinating to just learn more about finance. So thank you for doing this, and we'll see everyone again.
Awesome.